Broadcast. Welcome to the Zaner MarketCast, your one and only spot to keep up with all of the agricultural market news. My name is Joe Nikruto. I'm here with
Dan Hussey. How's it going, everybody?
Dan. Today we should have some big stuff to cover, and I bet we will, but as usual, we'll also be digging deep into the grain and livestock markets, especially looking at maybe cattle today in relation to what is going on this week, and educating folks on how best to trade and navigate these types of market movements is what we would normally say under these circumstances. Under these circumstances, with this kind of market movement, we want to just talk about how to survive. Been a wild couple of days, Dan, and I don't know how you want to characterize it, but I am going to say this is much more market movement than I had anticipated. Has left me slightly shell-shocked, and I look at a chart and I think, can that really be happening? And sure enough, you've got charts in front of you. You can confirm for me, but this is really happening, isn't it?
It's really happening. It really is happening, and it's not just in the agricultural sector either. I mean, really, the ones hit heaviest today were at the cattle, and then of course soybeans. Soybeans because of their ties to, I think, directly to China on the back of that news that we'll talk about in a bit, and then
crude,
of course
unleaded.
Right, crude. Oh, of course, right. But you've got at least in the agricultural sector, right? Cattle down off of, I think, on the backs of risk appetite, and we'll talk more about that later. I mean, wow, everything down. Is it ever going to be worth anything ever again, Joe?
Nothing will ever be good again. But before we start, we want to let you know that if you are interested in hearing about grain market movements and strategies to trade daily, you can sign up for our Ag Hedge Hotline, hosted by expert market strategist Ted Seifert. Totally free. Gives you the chance to connect with us personally if you have any specific questions about markets or agricultural commodities as a whole. If you're interested in learning more about how this price action normally works and how to make that price action work for you, it is a perfect way to take a first step. Link is in the description below to sign up for that. Totally free, zero commitment. We'd love a chance to speak with you about what is going on and how we may be able to continue to watch this very carefully. Yeah. Can I get an amen?
Amen, brother. Now, where do we want to begin today? Do we want to rip the Band-Aid off and talk about the worst? Or are we going to go and ease our way into it and talk about where we had a little bit of a green shoot in corn?
I think that corn market is a great place to start, because it seems to me that the corn market is sending a message, right?
Yeah.
Everything else is falling out. And, corn is hanging in. What is that all about?
I think that there's obviously been some strong demand there that was unexpected there earlier this year, right? We've seen that export demand kick up the way in the corn. And honestly, I think on a day like today, it was just a response to, hey, corn's not really a part of that Chinese news that made the rest of the market flush, which is, China's been light on their trade in corn. We've been gone back to hand to mouth on soy, it seems like, and we've really been more reliant on our other export partners for the corn market. And I think that until Mexico steps up and gets angry and says something, corn's probably going to be rather left out here in a collapse.
Chinese really haven't been taking corn from us for some time anyway.
Right.
Mexicans really can't afford to be without our corn for much time anyway, right? So Mexico on the USMCA previous tariff regime. And so unless that changes, or unless we find new negotiations around that, we're kind of status quo with Mexico. And it seems like the corn market is kind of signaling that, right?
That's correct. And that's exactly how I think, characterize that at this time.
Corn not trying to be below that 200-day moving average. What I saw was 453. Let me do this the right way, where I'll discombobulate it. Let me get back to the basics. May corn for the week opened at 453. High was 465. Low 444 in May corn. Last trade I saw was 460 and a quarter. That was up 7 on the week. Believe it or not, funds are long about 85,000 May corn. Maybe more after today. Corn not really trying to be below the 200-day moving average, that 453. We've jumped up above it. 10-day at 457, 18 at 459 and a quarter. All I can make from out of that corn chart is that we have done a really good job of not getting down to that double bottom. And here we are, not certainly escaping the pull of that double bottom, but doing a pretty good job technically, considering, right, the context in which this is happening.
Yeah, I would completely agree, right? We've gone a little bit maybe into a bear flag, some people would say, but the truth is that since last August and where we made, lows around 415 to the highs around 520 on that May corn chart, we're right in the middle of that range, holding above some of those major moving indicators like the 200-day moving average and that large upward slope and trend line that we've held since that time frame. We are, today's close was back above that 18-day moving average, which, just above it. But hey, that's a good look considering how bearish and how red the rest of the board looks on a day like today. So, right, you got to look and at least see where there is some maybe a canary at the end of the coal mine or at the end of the tunnel here, or I'm sorry, light at the end of the tunnel. What am I saying? I mean, beans would probably be the canary in the coal mine.
Not a tremendous amount of volume on that chart, but decent volume, but not. I mean, so maybe there's a little bit of wait and see there in the corn market. You don't have a giant volume bar the way that you do in beans because, quite frankly, you don't have the selling pressure likely in corn that you had in beans. And so to me, that looks like decent volume.
Corn's and I think corn is corn's very content right where it's at is kind of what I'm seeing here. While, there's, I guess, other demand questions that are getting rocked out in other markets.
And beans being the other market, May beans opened at 1023. The high was 1034 and 3/4, low 970 and a quarter. Last trade 977, down a whopping 46 on the week. Funds short about 44,000, probably a big chunk more than 44,000 after today. We'll be interested to see what comes from that. But they're big volume today in beans, and I guess you would
241,000 contracts today in the May beans.
So sweeping. You can't really call that a reversal, right? But really, you took out all that support. You are down near the swing low from back in, what is that, December?
Yes, that would be your December 2nd swing low here. You've got the 955 contract low for it. You're back into oversold territory on that RSI. A little bit of a bear flag, right? That was consolidating and broke lower. I mean, it was just consolidation. It was sideways in a range. We had built up from, the middle of February, the start of March, all through the end of the month. We gapped lower. We broke below that trend line support and just flushed out. And really, I think we've proven that anytime you've gotten below, I'm going to throw a little box on the chart here. Anytime you've gotten below basically this box, right? It's been a quick move. At least the one time we did, that's what the market told us before. So, okay, and by the way, that volume bar you mentioned today, that's something.
So which leads me to my next question. How shall we approach this? If we looked at this chart with no context and we saw a big move like we have here on the chart today, we would say, goodness gracious, Dan, tell me where just looking at that chart, you don't know what it is. Could be Chinese chicken feathers. Where's it going? If we settled today at 977, where's that market going to be in 2 weeks?
Yeah, 2 weeks it could be.
No, don't just tell me what the chart. Tell me what the chart says.
The chart tells me that we're going to probably see some follow through to the downside to retest that 955 area.
955 and likely below that with the violence.
Right,
with
that contract low.
Right, and lower than that.
Is
so
under threat.
$9. You're going to be talking about battling to hold $9 on whatever chart this is, whatever commodity it is. You look at that from a technical perspective and say that market is over and it will never be good again. You're going below $9. However, so that's one way we can look at it, like we would as technicians, with no concern about the fundamental or political context. But in this case, if you were to see, and I don't know if this is far-fetched or not far-fetched, but let's say you see the president with other leaders of other countries, most notably China, and they come together and say, you know what, we have managed, strangely enough, to hash out an agreement. we'd like to take some of your beans. Where's that market going? Without
Yeah,
looking
it
at the
could
chart,
right
just
back
thinking
up,
about
right? What
11.
man has made, we can unmake, right? Is what Joe's saying. So that you see some handshakes, you see Trump agricultural or trade deal 2.0, and it looks all great. This stuff can be shaped right where it came down. I've got up now the daily continuous chart for soybeans because I kind of want to point out just, hey, yeah, we're still trending higher since the 2000s. It's just, the trend line that we have been holding, we are coming back down to test. And that's why I want to point out that, hey, Joe pointing out a move back down to $9 doesn't break anything in the long term. It just says, hey, we're just testing that trend line a little bit deeper. We're not, no, it's a stinker in the short term. But I do want to point out that, hey, there is room to test into that upward sloping trend line on the daily, weekly, monthly chart still.
For the record, I would assign very low odds to us trading to $9. I really would.
Yeah,
I
sure.
think that you've got
Agreed.
I think that you've got higher possible odds that some sort of agreement is reached, at least some sort of a change in the tenor of the discussion that could lead to an agreement that results in another violent up move. And so that, to me, speaks to the challenge of looking at these markets, and specifically beans, where there could be where there could be some sort of deal between the United States and China, because this chart is telling you that they're concerned about Chinese demand for beans, or our ability to export 100%. Beans to China. Should that change, you're going to have a dramatic upside move with another big volume bar and another big, volatility begets volatility, they say. And it's just a very challenging time to have to look at these charts and look at these markets and think, okay, we're going to try to make some decisions here. And it will also be interesting to see the kind of feedback that our government leaders on all sides, no matter what country you're from, in a minute here, everybody's going to kind of look to the person in charge and say, hey, we would like to make some decisions based on what is going to happen here in the future. Can you help us get some clarity? Because that's what we put you in office for. And I don't care if you're in China or you're in the United States or you're in the Netherlands, somebody's going to look at you and say, how about we iron this out pretty quick? Is my guess anyway, right? 100%,
right? Like this was, there's already making the rounds of clips of, negativity of Trump had towards presidential jawboning that caused the market to go down. Well, now look who's the culprit, right? That our own administration is, of course. I think those that kind of knew how this strong arm geopolitics would go knew that these types of turbulent economic times would be the result. But seeing it, right, is a lot, and having to live through it is a lot more difficult and a bigger pill to swallow than just talking about it and the warning signs of good, risk management at the end of the day in these turbulent times. Because, hey, at the risk of sounding preachy, right, days like today, this week, this month, this year so far have been good, examples of why risk management strategies, looking and being prepared to protect that downside, are oftentimes, warranted, needed, necessary.
Absolutely. Let me shift gears just a smidge here. May bean oil opened the week 45.06. The high was 48.54, low 44.63. Last trade I saw was 45.84.
Yeah,
that was up 68, right?
Well,
up
off
68 on the week.
Right, and well off the lows of the day.
Well off the lows. That's
down
right.
off
Nice
the highs of the week too, right?
Funds
right
are short,
back into the middle of the range.
Funds are short 27,000 contracts. We fell off of the February high, but we bounced from the lows that we saw here this week. And the biofuel question still remains. And in my opinion, this chart is telling you that biofuel question may be on the verge of being answered, right? Certainly going to be a bit more difficult to get gobs and gobs of used cooking oil into this country from China, right? I don't know if that's going to math out.
A good start, right? Well, yeah, if there's other, lesser, and from Canada too, canola. Let's not forget, right? Competitive oil seeds and anything that can be used for biofuel other than soy oil is now kind of out of the table, off the table. And soy oil becomes the main candidate there if there is a shutdown to trade. So, okay, there's a silver lining there, I suppose, but still, I think the precipitous drop in the price of crude oil here the last few days, as well as the questionable demand for soybeans in general, makes the soy oil chart a little interesting. So I think there's a reason it's also caught in that larger range here, below 48 effectively, to 50. That's been the upper band of that range, supportively down around 40 to 38. But hey, it's a range until it's not. Get bullish above 48, bearish below 40, and be a range trader in the middle. Watch that 18-day moving average as it crosses over the others. That has been a pretty good indicator of long term here on this chart.
Of the most excited discussions we've had in the past year, especially since that biofuel conference that we attended in St. Louis. Shout out to Susan Stroud for that biofuel conference. Ever since we've come from that conference, we have been very excited about the possibility that is present here. And I have to feel, or rather, how do you feel about what is happening? Has he implied that this biofuel thing is in the pipeline or not?
Yeah, I think it's been implied that this is supposed to happen and to look out for it to happen. I've been under the impression that it's been, considered because of how it will create that domestic demand. But I don't love that, like, we took other things like, ethanol mandates and have rewritten and taken some off the table. So I think this administration actually needs to kind of prove itself that it wants to do some of the things. I'm optimistic that Rollins and some others that he surrounded himself with, that is President Trump has surrounded himself with, are more apt into understanding some of the situations that we need to generate that domestic demand. But man, I don't know. This administration, you just gotta wait to believe it when you see it, right?
I am not a farmer, but boy, we talked to a couple, don't we? And I think in this instance, we might be able to speak for them and say they would much rather have this biofuel deal done than a check show up in the mailbox. You know what I mean?
Absolutely,
so
right. Like, I think everybody understands, if you want to really support the economy, you want to support the farmer, support their livelihood,
right?
Don't support their paycheck, right? There's a difference there. And, producers and farmers and people in agriculture understand that.
Which, and again, avoiding
fine people of agriculture.
Avoiding the standing up on the milk crate here, but just to say what I think everybody believes to be true is if you say that you support agriculture, which is the backbone of this country, here is a very fine way to prove that, right? There is no debate after they pull off this biofuel deal whether or not these guys are all on the right page. I mean, just a tremendous, tremendous, exciting opportunity for American agriculture if they manage to get this done. And per our experience, we know farmers can grow it, right? Here in America, we do a great job of growing all of this stuff that they're going to use for these fuels. And per our experience, we have spoken with people that will take X million gallons of this stuff today. And so what's in the middle, right? What is in the way? Big oil and a slightly less big American federal government.
I like the way at least half of that definitely sounds. And it's definitely the smaller government portion, but hey.
How about meal? Meal looks terrible. Open the week, 293.90, high 296.90, low 282.10. Last trade I saw was 283.10, down 10.40 on the week. Ugh. Funds are short, almost 100,000 contracts there. That chart looks bad. That chart looks bad.
Yeah, it does. And it's almost like you ask yourself, how can it look any worse? And then I just want to bring up, this giant descending triangle, it's looking exhaustive. So the thing I will say about it is, like, this is, you need to bounce to call it a low, but like, it's looking like it's gotten so beat up that at some point there's got to be value here, right? And that's where I'm cautiously optimistic we'll find it. Where's that demand for the meal?
What is this chart telling us? Is this chart telling us bird flu? Is this chart telling us PRRS? Is this, I mean, it seems to me like there should be a message in here. Is this chart telling us that Argentina is back as the world's exporter of meal? I just there has to be something.
I think that last part is probably the biggest portion of this, right? Like beans have been flying off the shelves, in Brazil. You just mentioned, to me before we started the show, we talked about the boats, the never-ending supply of boats leaving Brazil. Well, I mean, that's all South American trade, and Argentina is obviously catching favorable trade winds.
Makes sense to me.
Yeah.
Live cattle. Dare we talk about the third rail here of commodities, agricultural commodities today. Live cattle, Dan. Every week we sit here and say, "Oh man, one of these days you're going to get a bit of a turnaround," and then rallies next week. All the numbers have been. You're not increasing supply. There are concerns about getting feeders across the border. Tremendous demand here in the United States for feeder cattle. There is this meat is moving through the system. Cash cattle trade has been robust. You really aren't seeing, and we were discussing earlier before we came on, we were discussing the possibility that we might talk about the difference between what is happening fundamentally and what is happening on this chart, and that you may see some divergence in that your cattle fundamentals may not be changing, but it's possible that this cattle chart is looking at the stock market saying, okay, if you're about to throw the world into a global recession, boy, I wonder how much meat you're going to be able to get out of the United States. Is it too soon to infer that from what is taking place?
I mean, I definitely think that there's a notion of risk off mentality here. Cattle markets are very prone to recessionary periods of slowdown. And certainly, the fund category that's active in the cattle, if they've got profits in the cattle market and they all of a sudden are on margin calls and getting hit over the head, and other markets
Good point.
A drop in these equity indices, all these other, literally anything else. If they need the money elsewhere, cattle's probably one of the first markets they're going to liquidate, take that gain, go to cash in the cattle. Cool. Chalk that one up as a good win and, work their way out of the problem spots then. Cattle
and
wasn't
that's sort of what it looks like here today. Is that yesterday at the beginning of these moves, cattle market just kind of take a wait and see. But here today, with the weakness again in the stock market, it strikes me that
now
maybe
it just can't ignore it, right? I think that's what today kind of was, right? Like
your $300 tie wearing New Yorker.
We're off the highs, cool. And then today it's like, oh no. Like we started off lower, got below that 18-day moving average in the June cattle, and then just completely fell apart. 55 days down at 196, not too far below us. 100-day below that at 192, 200-day down at 185. And again, I want to call out this 190 to 185 area. That's the old summertime high. If we look at that daily continuous chart on cattle, you can see it over here. That's top from last year. I guess the continuous chart, the highs were down around 130, but no. I take that back. Here's our June top, right? Down around 186, 190. I wasn't lying to you, folks. It's just I was going too far back to like 2020. We're way too zoomed out. This is that time frame that I think we could go back down and test around that 185 to $10 mark, on a much larger pullback. Think big picture here, folks, right? On that continuous chart, it shows up on that. And you can see it here on just the June cattle chart itself. So that's the big area of support on the chart that we really could come all the way back down to. But let's see. Joe pointed out earlier in the broadcast, that China can shake hands and have a good, a kumbaya moment with Trump, perhaps, and as can the rest of the world. And we might actually see, a very quick V-shaped recovery. And cattle's a place that could become the case as well, because, hey, the guys that were happy to be long cattle at 200, they're going to love being long cattle at 185, right? So
that sort of begs the question. I'm sitting here watching what you're saying intently, because my thought is, okay, with this move today, has the train for risk management left the station?
I love what you're thinking, Joe.
With this big down move, is it too late to get protected for a move to 195? And
well, again, let's go out to that
saying.
daily continuous chart again, right? Like, look at how far we came over the last few years. If you're a cattleman and you're looking at these prices and saying, boy, I wish I could lock them in for the next few years or something, or at least through August, or at least till whenever. Well, can Joe and I help you out with exactly that, right? Because it's a long way back down to 150 or 100. if this is the tippy top for, a considerable point in time. But, let's call it what it is, right? A headline driven move, and kind of during a black swan event. If this has happened before, just look at like early March, where the market was down and flipped and took us from 190 up to 212 in just a couple of weeks time, right?
And so that's really what we have to suss out here, right? We are walking around in the land of unintended consequences.
Absolutely. There you go.
With no, with no safe harbor to be spotted yet. And so what I wonder is, like corn, are the cattle market fundamentals strong enough to get us to not have to worry about putting a floor in, right?
No, I don't think so, right? Like I think when let's look at this cattle market right now and think about ourselves like as if, let's just flip over real quick to look at corn and a couple of the tops in corn where to remind a guy like, of a time when you wish you could have done something better, right? I think cattle's no different. You have an opportunity here where we've set a price and coming off of, highs in a market that we are all jolly to see. Now the market's telling you to sober up and look at the reality of your operation, and our price is still at a favorable place. I'd say right around the 200 mark is still a great place to get some protection, or think about doing protection still. Protect against a break below 195 or 190 right now. By simply buying a put when you're way up here can be the simplest way, right? I think to protect anything, just because puts are the cheapest when you've been up here. Yeah, on a day like today, they're a little more expensive, but it can be the simplest way to get a little protection on, and lock in a floor for your operation.
And how about this for our educational piece today? The idea, Dan, let me know if I'm barking up the wrong tree here, but if you look out to August, right, and you purchase August puts, or maybe even a little bit further out, you have a lot of time in that. And so what you could think about in terms of these puts is more along the lines of renting them as opposed to buying them, right? So we're gonna
Certainly
rent some puts for some temporary protection, and we're gonna see how this shakes out. And if cattle checks up and starts to rally, we can easily let them have the puts back, put them on, take them off.
And we also talked about, okay, if we'd like to maybe even be long cattle down at 185, and not necessarily long, but like if there's demand down at 185, right, the market goes down. Okay, if just a put for 7.25, if the 195, which is your at the money put, doesn't strike you as a way you want to spend your money, maybe it's a little too much. You can cut that almost in half by then selling the 185 put and having a 3-cent cost to a 10-cent spread to the downside for the next 10 cents if cattle does start to break down from here, right?
In essence, you own that
floor in.
After costs, you own that full 7 cents between 190 whatever and the bottom end of that put
Correct.
spread, right? Yeah, that's a beautiful
Correct.
thing. Beautiful thing. And you're renting it, right? We can consider it a
you know
rental.
what? This could also be considered a speculative trade, a way of speculating on lower cattle prices with finite risk, right? Because here you're risking about $1,200 to potentially make, what is that? 10 cents, but less the cost of it. There is about $4,000. That's a finite risk reward ratio that for the next 119 days, you're betting that cattle is going to be live cattle will be below 195, right? And the idea is that that put spread stops gaining any value below 185 effectively. But of course, we know with time value and other things that isn't quite the case. But nevertheless, it's an interesting way of taking finite risk in the futures market to look at a downside play.
I don't think that there is any, and I'm reluctant to say this because there's almost guarantee that we take out those lows. I don't
right,
think that
exactly.
there's any possible way that you can, if you look at the fundamentals and you look at the way that beef is consumed in this country, and beef being consumed kind of on an upswing, people recognizing that, that thoughtfully produced American beef is essentially a superfood.
Love it, right?
It's just,
we are blessed.
There's just no way. However, from a speculative standpoint, but if you were a producer And from time to time, I can be not currently correct, which is another nice way to say wrong. If that market does fall out and you do have some sort of systemic, and even then, if you remember the pandemic, what was the first thing folks did, right? So after you stocked up on toilet paper, they went and bought up all the red meat. And so, if we go into some sort of 2008 style discretionary recession, people will probably, I still think people would be focused on consuming red meat myself. Personally.
Yeah, I think in the start, and then the issues will be, how does the marketplace actually continue to meet that demand, right? Because then you get shortages, blah 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 blah. Just discussion for another day, right? For now, we can all agree that red meat's not coming off the table of Americans anytime soon. It's just a matter of, right?
Nor should it.
Yeah, right. It's a matter of other things going on in this marketplace, packer demand, just blow off top prices of cattle, that are really driving price action at this time. And then of course, just the risk off scenario of that we've seen in across the board and in the macros.
How about feeders real quick? You look at the open on the week, 287.70, high 289.45, low 279.10. Last trade, 279.42 and a half. That was down a whopping 750 on the week. But here again, right? You look at sale barns all across this country. The demand for feeders is near rabid, right? They're taking feeders wherever they can get them for whatever they cost. The fundamentals in terms of feeders are simply not changing right now. Now the market's job is to anticipate a bit, and everybody's looking over at the stock market. But really, we didn't just magically get a whole ton more of animals to make up any shortfalls. And so it'll be interesting to see if feeders can be leaders on the way back up, or at least can lead to a stabilization here that might give us a bit of a signal. I simply can't see. I wonder what it would take to let feeders come down dramatically from this stage with these numbers. You know what I mean?
Well, I think it's just a correction, right? It's technical, it's money driven. It doesn't, throw the fundamentals out the window for a second, right? When you're limit down like this, there's a reason you're limit down. And I am of the camp that the market's just unwinding that run up. It's testing back into where we've been. Again, that 270 to 265 area down into the 100-day moving average and those old summertime highs you can see here on the continuous chart too. It's a similar area we just looked at on the live cattle. So I think that's where we'll probably hunt down into. We pulled right back into that 55-day. August feeders haven't quite got to their 55-day moving average around the 277 area either, but a big volume uptick on the cattle too, on a limit down move. Like I don't know if this was the capitulation that then will take us back up to new highs. I think we'll have to find a trade agreement really, really quickly for that to happen. But I do think we'll go down and find where the demand, where that value area is on the chart. And then at least we know for the uptrend that we've been in, that's the place that I would stick a pin in it for my.
That chart that you're showing there really, really shows how spunky feeders have been, the way that we are.
Yes.
That's an 18-day that we came down to test here, huh?
Correct. Oh,
My
no, the
goodness.
18-day we broke below. We came down to the 55-day here. That 18-day was what we were holding up. We broke below that. We closed. Look at that. We closed below the 18-day, and it was like the perfect sell signal, right? And then all of a sudden, just down. First day we closed below the 18-day since February.
So we have been kind of laying on the 18-day.
Yes, we were using it as support, and look, it's been a great, it's been a great trend indicator, and that's why Joe and I will continue to talk about the 18 and the 20-day moving averages. The smaller time frame trend daily moving averages can be great short-term trend indicators. And well, wouldn't you know it, flipped off a bearish trend indicator. Now we're oversold in the daily RSI, big uptick there in the volume to the feeders. So it just, it looks like we're going to be heading down into, where's support? I see upward sloping trend lines. I see 100-day and these old highs from the summer, as well as the old support around this 270 to 265 area. I think it's very natural for the market to want to pull back and test into that area at this time.
Certainly. I can't see how that's going to happen fundamentally, but that is the absolute setup technically, isn't it?
Yeah. And real quick before we go, folks, I do want to point out and at least show a chart of the dollar index. We've been in this big range for the last, couple years. Pre-COVID, we were in the 90 to 100 range for about 5 years. Then COVID The dollar spiked up and broke above our post-COVID world. Now we've been in this 100 to 115 range and really 100 to 110 range for the last 2 years. Boy, the dollar has sold off dramatically since the start of this year, all the way back down to the low end of that range. So I'm watching and watch this 100 area. We start to slip below. That could be a signal for longer term dollar weakening. And that's something that we should continue to watch, because that could be, I hate to say it, but that could be a saving grace for some of the commodity markets and our export markets, that if we have a 25% tariff on our goods or 10% tariff on our goods, the dollar could correct lower and take away all of that from a currency move as well. Yeah. Right? Wow.
Well, happy Friday. Happy Friday, everybody.
Yeah. So Carter has to have left us with a question of the week. I don't know about you. I want to go enjoy my weekend now. Try to get the red away.
So this question reads, if you could only eat one type of candy, assumes that we are some candy eaters over here. And I'm not sure about the implication of that from Carter. But if you could eat only one type of candy for the rest of your life, what would it be?
Reese's.
Straight up peanut butter cups?
Reese's peanut butter cups. Yeah. No questions asked. I thought about this one. Yeah.
How often,
Reese's peanut butter cups. Absolutely.
How often do you and I instantly agree on stuff? We probably instantly agree on meat.
I'm sure if you sat me down and walked me through some of your favorite whiskeys, they'd be my favorites as well.
Probably true. Yep. Little mellow corn won't hurt anybody. Best $17 you'll spend all week. But in terms of candy, I agree with you. I want to add. No, I want to add. I would like to not agree. It would be make it interesting. It would be better.
Reese's
Carter, producer Carter. What say you? He's over here about 8 feet away.
Hear me out. I think Reese's peanut butter cups, if we made them just freely available to the world, we could instantly end all of these tariff wars. They're the greatest American. They're the greatest American invention, bar none. Better than the internet. Better than just everything. You name it. Greatest thing anyone ever has created. I love those things.
They are really delicious, and especially if you can get them just slightly cold. Oh, and you open them up and they got that little bit of condensation going. Oh, man.
I had a deep fried Reese's peanut butter cup in Scotland.
Holy moly. It was good.
Oh, it was delicious. It was incredible. I think they freeze them, batter them, then deep fry them, right? So that the Reese's peanut butter cup wasn't just totally destroyed in the center, but it was like one of the best things I've ever had.
That's a really good idea.
One of the best things I've ever had.
30 Helens agree. Reese's peanut butter cup. Carter, what's yours?
Hershey's.
Hershey's what?
Straight up Hershey's chocolate?
Yeah, that's what he's saying. Just a straight up Hershey's chocolate bar. Old school Carter over there. You know what I mean? That's cool.
That's
nothing wrong
hysterical.
with that. All right, Dan.
No, not at all. Well, thank you for listening to the Zaner MarketCast today. If you need more because you just can't get enough of us, you can follow us on Facebook at Zaner Ag Hedge or on Twitter and on LinkedIn at the Zaner Group. If you have any questions you'd like to ask and have answered right on the show, there's a link provided in the description to do just that, and we'll answer it right here on the air. Thank you again, and be sure to like, comment, and drop a follow for the podcast to not miss a beat. And we will be back with you all as price action develops. Have a great weekend, everybody.
Thanks, everybody. Hang in there.